Hi, Dennis. How you doing, man?
Great. Hey, Andy, good to see you. How are you?
It's going well. Good to see you. So we're coming up on the second half of the year, and I want to say I thought the first half there would be more fireworks, if you would, which it really wasn't. Um, and I just want to get your thoughts, impressions, what you were seeing for the second half of 2023.
Yeah, I mean, you're absolutely correct. I think that overall the economy and therefore the equity market did a lot better than people anticipated, a lot better than I anticipated. I was under the impression that the leading indicators that we've seen over the last 12 to 18 months, the inverted yield curve and so on and so forth, that always um, precedes economic slowdowns and recessions. So far, it hasn't happened. We had a bit of a banking crisis in regional banks, which kind of scared me and a lot of traders and economists. But so far, it's been being contained. And the rally in the stock market at first, when we said the stock market's sat there and went nowhere the first part of the year, the internals and technicals were kind of iffy and actually kind of bearish. I think we touched on that last time we talked. But the market weathered the storm, and the last month we've seen a very good rally. And this is for the first time this year, or first time in the last several months, that the rally was not just about several NASDAQ stocks. It was broad, and that was kind of impressive. So it kind of changed my mind about being on the bearish side. Not that I'm overly bullish, but things improved,
Right.
and that's quite interesting. So, and a lot of people who were on the bearish side thinking, what is going to derail the market? That's the question. And the interesting thing, I looked at economic reports, and I actually put some notes, the economic reports that came in last week. I mean, you got weekly jobless claims much better than anticipated. U.S. housing starts up 5% year over year. That's their highest level in 12 months. Even the GDP, which we didn't have much growth, they were revised. GDP was revised to 2%, considerably higher, and durable goods all accelerated in May. I mean, it's hard to be bearish if you're an economist. If you look at the market from the macroeconomic stuff and fundamentals, these are good signs.
Yeah.
So that's
Yeah, I'm glad you brought that up. Let me ask, I have some thoughts I want to share and see what you think, but before I give my thoughts, I want to know, or I'm asking, are you seeing some quantitative easing from the Fed, or comment about that, or what do you see from that?
I don't. Not at the moment, at least. So what I'm thinking is, the Powell said that they're not done raising rates, which they're still fighting inflation. And okay, inflation is coming down, which is a good thing. I think so far they've done a good job. So his latest speech was clear that they're going to do it once or twice again this year. So I don't see any easing. The only thing that could derail this are regional banks. So we weathered the storm 3 months ago. Only a few of them went under. But what's going on is, if you look at the total debt as far as car loans and real estate, especially commercial real estate, and I'll touch on that. I got my notes here. That is a canary in the coal mine. There's a lot of them are going to be refinanced. And refinancing at these levels, it's bad for banks. It's bad.
It's very deflationary.
Yeah. So everything is dependent on banks, especially regional banks. The stress test that the Fed did for the bigger banks, they passed the test with flying colors. I think they're fine. Right. Bigger ones, the JP Morgans and Bank of Americas, I think they'll weather the storm. They'll be okay. But the smaller ones, I can give you, I got some notes here again as far as projections. And like auto loan originations hit a record of 700 billion last year. Total outstanding debt, we had 1.5 trillion at the end of March. That's enormous. And the most dangerous thing is the 12-month moving average for total delinquency rates reached over 3%. And that's the highest in 13.
Wow.
So that's just car loans. And that is something that, okay, right now the short-term interest rates are about 5.25. If they raise more, we're going to approach 6. And at those rates, that is dangerous for banks. So.
Yeah, well, about that. So I'm looking to potentially purchase a house in another house, and I mean that just getting more space in and selling the current house that I'm in 2024. And I was talking to my friend who's a mortgage broker who that's who I do my mortgages through. And like 800 grand, $1,000 home, you're looking at about I want to say is about $4,500 to $5,000 for your mortgage payment,
like
which is going to,
right?
Yeah, so which is going to be like, I mean, that's my mortgage is like it's less than 3% right now. And what I mean, so I'm going to be paying significantly more for that. And so what I'm trying to say is like, I'm waiting for rates to come down. So it's like, what is this going to do to the housing market? And I'm going to make an assumption that Powell is going to continue to raise, right? So what's that going to do to the real estate market?
Well, that was expected. I mean, for the last year or so, everybody expected it to slow down, but it did. It did for a while. But look at the latest reports. I mean, it's back to normal. I think maybe people have a lot of equities in their current homes.
Yeah.
And that's, if you buy whether it's a $500,000 house or $1 million house, they put, 25, 30, 40% down.
Right.
So, and for their mortgages, not as high.
Well, or they pay cash. Because I was talking.
Oh yeah, they pay cash. Yeah, completely.
And I'm in Atlanta, and I'm just talking to him again. He's busy, even at these high rates, because people have so much equity in their homes currently that they're still buying homes and taking out a loan. They're just taking the equity of their current home and using that as the down payment for, whatever else they want. It's interesting too, is I think this is a lot more regional, because what we're seeing here in the Southeast is a lot of residents from the Northeast, again, for whatever reason, they're migrating to different states. Maybe it's for weather, maybe they're getting older, maybe it's tax for, significantly a tax break or a job or whatever have you. But he said that they're seeing still a big migration to the Southeast, and I don't know where else that is in the country, but I think real estate has become a lot more regional, if that makes sense.
That's very true. I mean, I'm very close to Portland, Oregon, and it's the opposite of where you are.
People leaving.
People are leaving. Yeah, there was. Well, I've noticed it, and just because I'm close, I'm on the Washington side in Vancouver, but it's right there, basically, with their suburb. And people are leaving for like the reasons you said. I mean, the taxes are kind of outrageous. Plus, all of a sudden there is a lot of crime, things of that nature. And now they want something different. They're moving to Idaho, they're going south, they're going somewhere. So
Texas, Arizona.
Yeah, Arizona, maybe warmer climates, different reasons. And but real estate agents who I talked to, they said that the real estate slowed down, but it's not a disaster. So
yeah, and that's in your area, which you said you has a net outflow. So that's interesting.
Right.
So I guess I have a theory, and let me know what you think. So we're going to assume here that Powell is going to continue to raise rates. I don't think, and I was moderately bearish previously, but I don't think Powell raising rates, the Fed raising rates. I'm a lot more neutral, if not a little bit positive going into the second half of the year. And here's why. I see a ton of money that has sat on the sidelines.
Oh yeah.
And I think they were going to want to deploy that money. That's number one. Number two, you indicated or shared some stronger than expected economic data. So that's going to force that money to be deployed. That's the first thing. The second thing, we have an election next year. And it's hard for me to see things being too negative in an election year. Now, they might, here's a caveat, they might get really negative in the fall. But they're going, if that happens, it's just going to be in the fall. It's hard for me to see much of an overlap past the fall because of the election cycle. What are your thoughts?
I agree. I think from the economic standpoint, those reports lately, they haven't surprised me necessarily, but they kind of assured me that things are not that bad. Where is that recession? Even 3 months ago, we were having a conversation, not just us two, but economists and traders and financiers. The question was, is it going to be a hard landing or soft landing? Right now, I don't see any landing.
Any landing, right?
There is no landing. I mean, it's where is it?
Yeah.
And therefore, from the stock market standpoint, it has improved. As I mentioned, a lot of things are starting to, in the industrials, for example, basically are all-time highs. And things like that. Even small caps, they were down in the toilet for many months. Even they started to participate. The only problem is still regional banks, and we touched on that already. So they're not going, they're just stuck there. But AI makes everything very lucrative and interesting, because it's one of those revolutions that probably similar to what we had in the 90s with the internet and the telecommunications and things like that. We don't know where it's going, but there are positives and negatives, but mostly positives. It's amazing what's going on right now. And usually new innovations just throughout history of the United States or the world produces higher equity values and things like that. That's
it's like a bleed out effect. I mean, it bleeds into other assets or other companies.
And as far as the Fed, I believe Powell will do what he said, meaning he would raise maybe once or twice, and that's what he said. And it might create, like you mentioned, it might create certain explosions here and there in the fall. But I don't see, from the stock market point right now, I don't see any major reversals to the downside, bearing some geopolitical events or something like that. I think pullbacks will be minor, corrections will be minor, and we're either going to go nowhere or we're going to try to challenge the all-time highs. I mean, that's the way it's looking right now. And every trader can be skeptical, but I'm looking at it like, I like what I see.
I think we got to lean into the data here, and the data is
right. And also, and we talked about, for example, energy. That was the first part of this year is kind of bumpy. I think it's starting to look a lot better. And,
so let's talk about that. I think you're right. I think we've talked about it for, I don't know, six to 8 weeks now. That maybe you're a little early, but we'd still buy. I mean, I'm knocking on the wood with both my hands, but everything I know points to higher energy prices from here. From Saudi cutting another million, for already us having a deficit, or I'm looking at the oil reports that we're having drawdowns. We're really starting to get big drawdowns. And then that Saudi cut is coming in July. The OPEC cuts came in June. And then let's assume for a second our theory of the economy is actually improving. I mean,
more demand. Yep.
Yeah, exactly. It's hard for me to. And then technically speaking, we've had several bounces off the high 60s in crude. And then to throw all that in, we've had very negative sentiment, which is a
Yeah,
bullish
we
thing.
talked about it last time, right?
Right.
So I think we're sitting, as far as the commodity itself, we're somewhere at the bottom, which is bouncing because there is no reason to go down.
Yeah.
And just like we discussed last time, I'm more interested not necessarily in the commodity, but the equity side of it, the indexes and individual energy stocks. And remember, we talked about XOP, one of the
Mhm.
ETFs for energy ETFs, and they were sitting at the bottom. We were talking technical terms, around 120-ish.
Mhm.
Right now, around 130. It's a good sign. I'm holding that position in options.
Yeah.
It's looking a lot better. It has 200-day moving average right in front of it, buck 32 or so. I think it's going to clear it. And there's a lot of room on the upside. I mean, they're looking good technically, and fundamentally, they look. I mean, they're cheap. They're still cheap.
Yeah.
I
Well,
looked
that's it.
the
They're
other
still
day.
cheap relative
The
to the
PE is
underlying
like
asset.
5 on an
Yeah.
average. It's absurd. It
It's a
really.
no-brainer. It's a no-brainer.
Yeah, that's one of those great trades. As far as precious metals are concerned, there's this stock right now. Usually summer is not, it's not a great time for them. So I'm
Yeah.
not. We'll see. They'll probably come alive maybe around September or so.
Yeah. I'm
There's
thinking
some
August,
turbulence.
maybe September, but yeah, I agree in the
Mhm.
fall. They're just choppy
Right.
right now. I was talking to a fellow trader of mine, and he said some of his Indian, he does a lot of business overseas and Indian contacts, and he said that they're big buyers at about 1900. So he said that's going to
Okay.
be your floor, is high 1800s to 1900s. You're going to see a lot of buyers come in if it goes that low, if gold goes that low.
Right. Right.
And silver, you're getting some buying in here, but you're going to get a lot of buyers if it comes in below 20. That's when you get it,
I
which
guess. Yeah.
you might get a flush out. Who knows? Or you might just get nibblers here, but I don't think you're going to see a move until the fall if you see a move. So
Yeah, I think summer is going to be kind of dead. Well, summer meaning the next couple of months or so, but after that it might get interesting depending what the price is and where it sits and so on. Right now, I don't have any positions there. A couple of stocks, but
got it. Well,
however, copper is very interesting, and
I wanted to bring that up.
yeah,
That's very interesting to me. I think that's a great trade, or setting up to be a great
mhm.
trade.
Yeah, I think
What do you think?
copper is well. First of all, it a lot of times it acts as a leading indicator to the economy because it's on demand and it's an industrial metal.
Right.
And sometimes it leads, sometimes it follows. But considering the economics that are hopefully improving, I think copper is the first one's going to benefit from.
Yeah.
I believe that
And
of all the metals, this one is by far my favorite.
I would agree. It's my favorite right now. And I think fundamentally, just projecting over the next several years or few years, several years, I believe we're going to be in a significant deficit of copper. So,
Oh yeah,
um,
there is. Yeah, there's just basically shortages sometimes.
yeah,
So.
yeah. So yeah, let's talk about that. Setting up, what's your number one besides energy? What are your number 1 and 2 trades going into the end of the year?
It's hard to say. So besides energy, I would look at I like healthcare stocks because they are practically immune from economic shocks. I mean, if there is crashes and bear markets, of course
Right.
everything is down. There are interesting developments, I think, with AI with them. They're interesting. They are underpriced. I believe they were kind of forgotten. It was going nowhere. I like them in general. They're not overpriced at all. I think they're underpriced. This one, as far as we're talking about bigger sectors, I like them. I really do. So I'm a more of a, at this point, I don't want to jump on growth story. I don't think there is much growth, so I'm not interested in high tech. I know they're doing great right now, but they're very expensive. and it's not my cup of tea to just, be my
Chase.
trader. Yeah, I don't want to chase. So, and you can find a lot. It's idiosyncratic. It's not necessarily, you pick a sector, an industry. Small cap value. It doesn't matter what industry or sector. They're very underpriced. They're sitting there at the bottom. They're just trying to move up, and that's where I'm looking for. I don't have an example for you at the moment. So, but I'm doing some research as far as smaller cap stocks. I think they're going to benefit.
We can do that next week.
Yeah, and I think in a in a rising rate environment, I mean, growth does okay, but less so, other than some Nasdaq stocks, and are searching for value. And I think that's the right way. Energy, that's why we talked about energy, because this is value. So that's where you can find diamonds in the rough there that can, go from 20 to 100%. So in a matter of months.
Really quick.
Purely fundamentals and macroeconomics. So if you add the technicals to it, that'll help. So that's what I'm looking for at the moment.
Yeah, I would give you, again, we both love energy at these. That's probably your best trade. That being said, I love your copper trade. I've been thinking a lot about copper recently in the past several weeks, and I would play the equity side, even though I think the metal's going to do fantastic, but I think the equities, and I'll name drop some equities as we move forward. But I think that's a play in the fall. I think another one, here's one for you that's becoming to me very interesting, but this is a multi-year play, and I think I'm early. That being said, I'm really becoming interested in the uranium market, just because of all of the, let's assume for a second that crude goes to, in the next 24 months, $120 a barrel or $130 a barrel, which I think is quite doable.
Right.
You're going to, and there already are, they're going to look for other sources of energy. Other countries are going to look for other sources of energy and clean energy. And in fact, Japan just reopened uranium. I don't know how to say this, but yeah, I mean, they're going all in again, not very much want to build uranium plants. Same with places in Europe. And in the US. So I see that as a multi-year play. But again, I think we're early, but maybe in the
I agree with you as far as longer term. Yes, longer term. Short term, when I look at them, I'm kind of lost. So they either going nowhere. It's but long term, I don't think you can be wrong with those.
Yeah,
I mean,
I would agree.
Anything. Another one that I actually forgot is just, you mentioned alternative energy, right? Basically, different sources of energy other than oil. There is an ETF called TAN. I don't know if I mentioned it before or not, TAN, and this is basically a green energy ETF. I think wind, solar, and all that. I think it looks fantastic. Because, well, first of all, they're trying slowly to get more and more share of overall energy. Right now, it's very small. It's like 5 or 6% of overall production of energy.
Yeah.
But in a few years, it's going to be higher. And not just our government, but most governments throw billions and trillions of dollars into this. So they cannot go wrong. I mean, even if they go wrong, it's still money flows into this.
Yeah.
So the one that I like, I'm not holding it at short term, but I like right now I'm trading it. I'm not holding it long term. I'm sorry, I'm trading it short term. But I think overall a product like that will do well over the next several years.
I would agree.
It complements your uranium story. So they're sort of parallel. So going in the same direction.
Yeah, I would agree. Okay. Any final thoughts until we see each other next week or two?
I think we covered pretty much everything. So I'm a little bit on the positive side right now. So I view corrections and pullbacks as buying opportunities, and watch out for those banks.
Yeah, right. Okay.
Control the range.
All right. Well, thanks for your time, and we'll meet up here in the next week or two, and just we'll see where we're at.
Thank you, Andy. Always a pleasure. Thank you.
Yeah, pleasure was all mine. Thank you, Dennis.